My name's Dino Lucharelli, and I'm really pleased to be here today. I want to thank the MTG team for the invitation to address you. It says somewhere in the guide that I'm a CPA, and I am. That's not necessarily the reason I'm here today, but I guess it's a credential that confers a certain level of credibility. I want to explain to you how I came to be in front of you today, because I think it's relevant, and hopefully it's relevant to many of you in the room. We have a management advisory firm in the Northern Kentucky area, and we service customers within 100, 200 miles of Cincinnati. And what we do is not the typical CPA things. We don't do taxes per se. We'll do your taxes, but only if you force me to. What I'd really rather help you do is implement a financial business plan and make a lot of money. And that really and truly is the guts of what we do. We work with business owners to help them set their goals and achieve their goals. And I came at this from years of working in very large companies, Federated Department Stores. Interestingly, the last job I had before I started my own consulting firm was about 15 years ago. I was a CFO at an electronics company, and we shipped $1 billion worth of electronics a year, and guess what? We'd lose a few trailers here and there, just as Scott was describing. I wish we had known him then. But the reason that we do what we do in my firm today is because we recognize that small business owners don't have the wherewithal to go out and hire $250,000 CFOs. It's not in your cards. But what you do have the ability to do is to put a business plan in place, implement that business plan, make sure you get paid first, and make sure that you grow your business properly. And so there are certain things that we do with all of our clients, and I can tell you this. Our typical client is anywhere from $1 million to $15 million in revenues. I have yet to have a client come to me in 15 years of doing this that already had a financial plan in place. I've yet to have one. And the reason that I hear from companies when they approach us, well, I don't know what I'm going to do next year. I don't know how much revenue I'm going to have next year. I don't know how many drivers I'm going to need. Well, you probably know more than anybody else in the free world. And particularly, if you want to find your destination, you have to set a goal so that you can measure your success or lack of success along the way. In the transportation business, a driver would never head out with a load not knowing where he or she will end up. Why would we allow our business to do the same thing? So what we do is we help companies access money. Back to how I got here. I have a client. The client is in the trucking business. I'll call him Johnny. Johnny approached me and said, I'm in trouble. I have an MC number of 1. So I said, well, that's good. But I'm a little deep in debt. I'm behind. I don't know what to do. Johnny's been in business for 40-some years. Johnny has 15 pieces of equipment. He had 12 drivers. He didn't anticipate losing 3 of them to the competition and 2 of them getting sick in the same year. He didn't anticipate getting diabetes himself a year and a half ago. So what happened is the bottom dropped out of his revenues. He found himself unable to keep pace with his financing needs of his business. So now he's not just looking at not being able to pay himself, but he's looking at potential meltdown. It was through that relationship with Johnny that I met Brett Conyers along the way, because when we get involved with our companies, we get involved with all the professionals. And working with Brett and working with Johnny, I can't make this up. He had 2 different banks that financed half of his trailers. One of the banks, I knew the bank president. I called the bank president the morning after I met with Johnny. I said, I'm going to get you out. I'm going to get you cleaned up. I know he's three payments behind. I need you to work with me. Bank president said, we just had a meeting this morning, and I told my lawyers to blow him up. We're out of patience. We can't wait. It's 3 months behind. I said, we'll deliver a business plan to you. We'll show you a recovery program. You need to give me 2 weeks. Trust me. Within 30 days, we had both banks refinanced. They doubled back the payments that were past due, added them back into the principal. Johnny continues on in business today. Johnny's having a better year in 2016 than he had in 2015. He's back on the road to recovery. Now, I tell you that not to brag about what we do, but I tell you that because Johnny was thinking he was going to end up in bankruptcy court. And now Johnny's looking at improving his business, growing his business, and having something for himself, even though he's 65 years old and with diabetes. So I want to talk a little bit about the things that you do and would want to do to be able to finance your business successfully. Not just finance growth, but keep it going. You may be happy with the level that you're at today. You may be doing $12, $15 million a year, feeling like we're hitting it. I just want to maintain. I don't want to do a lot of risky things. But even that requires capital. And so the reason we do the financial things we do and spreadsheets and balance sheets and income statements, it's not because it's fun to do. We do it because we need access to capital. That's the name of the game. Having investors and bankers, finance companies believe in us. And if we can't produce good, clean information, they sure as heck aren't going to invest in us. So we have to present a beautiful table. Think of yourself as having a dinner party, and you're inviting the bankers into your home. Let's think about that theme, and what do you want to present to them? You want to be investable. What does being investable mean? Number one, you already have money in your own business. So that already is the first predicate to being investable. I have people come to me that want to start businesses, and they say, I don't have any money, but I need an investor to front me. That's not investable. You're dealing with other people's money. If you want to deal with other people's money, you have to have your own money in the game as well. The second thing is having a detailed 3-year realistic plan. With the clients we work, we help them identify the key metrics to develop a 3-year plan. Here's why it matters. I want to borrow money from a bank. I've never defaulted on a loan in my life. And I tell the bank that. But the bank says, yeah, but everybody who defaults on me, it's the first time and the last time, because we won't lend them any more money. So that argument doesn't play with bankers. And they look at you and say, of course, I've heard that a million times. Tell me, not that you're going to repay me, show me in the math. Here's your income. Here's your payments to yourself. Here's your tax payments. Here's the loan payments you already have for your existing equipment. And here's what's left. Oh, and by the way, it better not be zero, because if it's zero, you have no margin for error. So what we do is we put a plan together, and we may say, the plan doesn't work. So guess what? We have to do some things differently. We have to look at changing some pay scales. Maybe we have to shrink. Maybe we have to move our location. Maybe we have to sell something. Or maybe we need to hire somebody to go sell more. But you cannot go to the bank and say, last year I made $150,000 a year. I need another truck. I need $250,000 to buy 2 trailers or 2 trucks, whatever. And trust me, I'm going to pay you back. They're going to say, prove it. Show me that you've worked the math out. And show me what happens if sales drop 20% and you miss your target. And show me that I'm still safe with my investment in your business. And when you can do that, you can get the money. I'll give you another story. Last summer, a guy's been in business for 15 years in a logistics company, doing $8 million a year. He had lost $1 million the year before. His bank had him at $750,000 on a line of credit. He was completely tapped, completely drawn. He said, I can't sell any more work. My customers are slow pay. I got to pay the carriers quickly. I can't do any more business. But I'm having a good year. Last year was bad. So what I said to him was, I'll take that bet. I'll get you funded. Because I looked at his business metrics. I liked it. He said, well, I'm not paying you anything to get started. This is all contingent. Because I had 5 other guys in here trying to get this done, and 5 people failed this year. 30 days later, we worked our butts off. We put together all the financial information we needed. We dressed up the table. He got a $3 million line of credit from KeyBank. Now, he didn't think he could do it, and he had to write me a big damn check. Because I said, you put it all on me, 100% contingency, which we really don't do, I'm going to get a big payment at the end. I'd have taken it for a third if he'd have paid me something down to show he believed in me the way I believed in him. But the truth of the matter is, several people tried, several people failed. Not because he wasn't investable, because he didn't make himself appear investable. You have to have collateral in your business. You guys are all about collateral. No problem. Visibility to revenues. This is the one that really sticks people. I don't know who's going to call me for loads. Well, you know who called you for the last 5 years. You can show trends of the types of things that you're carrying. You can show trends of the types of customers that come to you. You can show how you're faring relative to others in the market. You can rationalize. See, when you're talking to a financial investor or a banker, they don't know your business. They may have heard about your business. You know more about your business than they'll ever know. So tell them the story. Make it easy for them to say yes. This one kills me. So I'll talk to a business owner and they'll say, well, I don't know what I'm going to do in revenues next year. So well, how in the hell do you expect the bank to want to lend you money? Does that make any sense? So we make that happen. We put the plan in place. We back it up with historical data. We back it up with outside industry data. And it's out there. And we make it presentable. You have a great team. A lot of business owners get sort of wrapped around the axle with this issue of, well, this one guy, or you know, I got this star driver, I got this star dispatch. Financial investors get very nervous if the company rises and falls on one person. You want to have depth in the team. You want to have strength of a team. Can't have heroes. You don't want heroes in your business. Trust me. Product or service superiority. I'm sure that those of you have lots of repeat customers, they do it because you do something better than somebody else, and they get that. Strong IT, clearly defined roles and responsibilities, consistent, predictable cash flows. Well, maybe you don't. Maybe your cash flows are up and down. But what you want to do is try to demonstrate some measures you're taking that will flatten those out. Show them on a nice upward curve. You can do it by saying our contingency plan is if we don't hit these targets, we're going to scale back. We're going to take lower pay for ourselves. Could be any number of things. But when you don't have a contingency plan and you don't have a fail-safe, people get nervous. And then having an outside advisory board. When any one of us individually goes to a financial investor, say, if you have a group of outside professionals who meet regularly to talk and help you with your business, all of a sudden you have multiple credibility points for that investor to rely, not just on you because he knows that you are taking a salary out of the business, but you have outside professionals who will vouch for you. You know, if you're known by the company you keep, having an advisory board can be a very, very, very positive thing to help capitalize your business. You don't want to be this guy or that guy. You want to be investable. You want your investor to come to you to see the most beautiful place setting, to break bread with you in a world that makes him or her feel very, very comfortable. That's what you want. I'm using a little bit of humor, but I was working with a grain exporter. So he was all about logistics. So he needed a bigger line of credit. He was tapped at $600,000. He was moving $50 million worth of product a year. Now that's not a lot when you figure it's 2 or 3 points of margin, but nonetheless, he was totally tapped out. And his financial statements were terrible. I looked at his financials, it was horrible. I said, do you expect somebody to lend money to you when your numbers are so hard to understand? Long story short, it took us a year. Fifth Third Bank lent him $2 million. Get 3 times the amount of credit. His business is doing great now. How do you get the money? Banks are more risk averse than equity investors. An equity investor wants 10, 15, 20 points on his money. Bankers want 4 or 5 right now. Banks are a lot easier to work with. Equity has advantages because equity will wait. Started up a business in 2012. Some gentleman I knew came in and said, I'm really good at what I do, but I need an investor. 2012, November of 2009 was the lowest point of valuation for commercial real estate in the whole recession. So early 2012, nobody was lending money. We were able to put together a business plan, financial model. We got a $250,000 investor. We were able to get $400,000 in bank support and about $500,000 in leasing from truck leasing companies. That guy's doing $5 million this year, putting $1.5 million to the bottom line. Now, we presented a beautiful business plan, and we stuck to it. And this is where it gets important to have good regular management and reporting. It's one thing to have a plan. It's another thing to be able to say, here was our plan, here's where we are, here's why it's different. Oh, and if it's really good, here's what we're going to keep doing to make it better. If it's not so good, here's how we're going to remedy the situation. Just comparing to last year is not enough. Last year may have been a terrible year, or last year may have been a one-off year. Something crazy happened. What you want to do is be able to say, in a very positive way, we're going to have this much revenue, here's how we're going to spend our money, here's the equipment we're going to buy, here's the cost of money, and by the way, we're going to need a line of credit. And here's how we're going to manage that line of credit. And you have to have somebody speak with authority on your behalf to the financial markets. Whether you're doing $1 million a year or $50 million a year, you need credibility in the financial markets. People will say you're terrific at what you do, but I don't necessarily believe that you know how to account for money. How much can you get? No. It's not this hard. It seems hard, but it's not hard. It's harder than that. Rule of thumb. Typically, you can borrow 70 to 80% of your collateral, no matter what that collateral is. Banks and investors will do that. Now, if you're in a startup mode, or if you have a really great opportunity with, let's say you scored a contract with a major retailer and it's ironclad. I know you rarely get those, but it's ironclad and it's a 4-year contract and you can use that to go get an equity investor. It could be non-bank financing. But typically banks will go 70 to 80%. Different kinds of loans. Term loans, working capital loans, equipment installment loans, 4 to 6%. Now, many carriers are using factors. Factors are going to cost twice, 3 times what banks are going to cost you. You may believe you do not qualify for traditional bank financing. If you believe that, it may become a self-fulfilling prophecy. But if you're willing to challenge yourself and willing to dress up your business, now we're not talking about fabricating or doing anything wrong. We're talking about, I mean, you wouldn't walk in and, cut off shorts and flip-flops to a wedding. You'd put on your best suit. You do that for your financial investors. You want them to see you at your best. They know you have holes. They know you have flies in the ointment. They know that things go wrong. But if you present yourself as having all those problems and never the upside, it becomes a self-fulfilling prophecy. You won't get the money. And you'll be in the factor world. And you're going to be paying 2 to 3 times what you really need to pay. Equipment leasing. Equipment leasing is one of the ways that carriers can, obtain what they need. I have one of my clients. He went off the reservation on me. He leased 2 trucks at $150,000 a piece. Got a great rate. He didn't know how to calculate the rate. It's 9 points. If he had done them in traditional bank financing, he would have saved himself about $6,000 a month in interest. It's huge. Just didn't know. He went to the leasing company. So then after that, I said, let me help you refinance the next ones. So now our average borrowing cost is about 4.5 points on his equipment. Finance companies, interest rates approaching 20%. Equipment leasing companies are generally higher than banks. Equity investors will want a lot of money, but they may be patient. So you may hear about equity investors as patient capital, meaning you don't have to pay them any money in that first year, or maybe 2 years, maybe 3 years. They'll wait for a dividend or they'll wait for you to grow your business. An equity investor is your biggest cheerleader because he or she wants you to do really well. They want you to hit a home run. A bank does not want you to hit a home run. They want you to be slow and steady wins the race. All the bank wants is 4.5 to 5 points. If you're doing crazy things that would get 20 points, that makes them nervous. So interestingly, the equity investors and the bankers are oftentimes on different sides of the coin. If you want to dress yourself up and look good to financial investors, you need to have the last 3 years of business and personal tax returns, last 3 years of internal financial statements, income statements, balance sheets, and cash flows. I'll give you another story. Because I come from much larger companies, I mean, when I was Federated Department Stores, which is now Macy's, number 6 on a piece of paper would be 6 million. We rounded off the last 6 zeros, okay? But what we did is we produced a beautiful financial package every month, and we could line them all up, and they all had the right covers, and each one had an executive summary. Each one had the same formatting. Beautiful. So I went to a company, flash forward, 2006, that was deep in debt. They had done some crazy things. They got to 40 million and they bought a plane. Well, when the planes hit the World Trade Center and the economy took a dive, so did their revenues, and they dropped to 14 million the next year. So now they're at 14 million in debt and 14 million in sales. They were essentially insolvent. So we were able to come in and instill some financial disciplines. I got the bank to hold off. Give me a year. Because otherwise, you're looking at a meltdown of $12 million. I'll get you $2 million when we liquidate what few assets they have. Hold on. Give me a year. So for the next 12 months, we put in monthly reporting, monthly tracking, monthly financial plans, monthly spending analyses. At the end of 12 months, I went back to the bank. Said, here, we'll pay you $1 million down. We paid down $1 million. I need another year. Got another year. We get to the end of the second year. The bank said, well, wait, but we need the balance paid in the next 3 years or we're calling a note. We were able, then we had 2 good years of the financial statements done very cleanly, very crisply, very good accounting principles, very good accounting practices, standard balance sheet stuff that you guys don't particularly care about, but you feel like it's a necessary evil. We were able to get an equity investor to come in, $10 million and take out the bank. That equity investor stayed in the business, gave him 2 years of no interest. That company got back up to 50 million and was sold for a ton of money. The owners were looking at less than zero because they had pledged their houses. And so what we did wasn't magical. I didn't necessarily change the way they operated their business. What we did was we instilled a discipline in the financial reporting and financial management, financial planning, that made them eligible for the money. And instead of them getting the door closed by the bank, we had investors chasing us. I was their front guy. I had investors calling me. We'd like to get in the business. We'd like to be part of it. So now they're competing for our business as opposed to us going with our hand out to the local banks. So the financial management piece of this is the boring piece. It's the daily accounting for things. It's the accounting for issues, accounting for depreciation. You don't care about that stuff. What you do want to care about, though, is you can present a great picture. But you need to have a watchdog. You need to have somebody who really understands the way the money moves through your business. So let's talk a little bit about that. Most of our clients believe they know what their break-even point is, and most of them are wrong. They don't know what the break-even point is. Your break-even point is pretty easy to calculate. It's whatever your direct revenues versus your direct costs are, that number, okay? You divide your fixed costs by that number, and that tells you what your sales need to be to break even. So if you say, well, I don't want to just break even. I'm not in business to break even. I'm in business. I want to make $250,000 a year. Well, you take your fixed costs, add $250,000 to that, divide that by your contribution margin, and that's your break even. You go, so what? I have a number. Well, if your sales projections are less than that, then guess what? We got to go figure out how to get sales up to that number. Whether it's new customer generation, lead generation, whatever it happens to be. Or you may say, well, I don't know if it's feasible to get there. Maybe it's time to merge with somebody. Maybe it's time to rethink the business. Maybe it's time to scale back. We have clients who have very difficult times pricing their product. They'll price their product based on direct costs only. Well, if you're not accounting for your rents and your overhead and your dispatch costs, your insurance costs, which are the minor piece, if you're not accounting for those things in your pricing, at the end of the day, you cover your direct costs. The drivers get paid, fuel gets paid, tolls get paid, licenses get paid. Nothing left. So, being able to price your product, understanding how money moves, how to come up with those rates is a really important piece of your profitability picture. So here's a typical, we do weekly reporting. So many companies, for whatever reason, don't even get a profit and loss statement. Maybe they get it once a year, maybe they get it quarterly from their CPA. Their CPA doesn't really know what they're doing. Their CPA is like, it's for tax purposes. We don't rely on a month-end report. If a month-end report gets done by the 10th of the following month, guess what? That prior 30-day period is come and gone. You know, your ability to react to that prior 30-day period is past. But what we do is weekly reporting. So this is a scaled down version of a weekly report. So here we have weekly total and then per mile. So number of loads completed last week, customer loads versus broker loads. What were our billings versus our direct costs? And what was that per mile? Is that good, bad, or indifferent? Is that what we want? Is that what? Now, if you as an owner have this information available to you each Monday morning, then you're able to say, maybe I need to reprice. Maybe I need to rethink. Maybe we need to scale back on our customer or change our customer mix. Maybe we're not in the right place. And then basic things like how much cash do I have in the bank right now? What are my receivables? What are my payables? How much have I drawn from the bank? How much is left to draw? And then what's my cash flow look like the last 5 weeks? This is real-time data. This is the kind of information that helps you be able to manage your business today. The financial package that comes out at the end of the month, that's for the bankers. That's all. It's window dressing. This is what you need to make sure you know what metrics are happening in your business today. So you should expect to produce monthly financial statements and be accountable to your money source. Yep, personal guarantees are part of the game. You probably all know that. If you've gone out for financing anytime in the last 5 years, you've signed personal guarantees. It didn't used to be that way. Back before the financial crisis, people were given loans without personal guarantees. Now the personal guarantees are there. And expect to meet regularly with your financing partner. One of the things people do wrong is they get the loan and they go quiet. The bank calls, wants to meet. We're too busy to meet. Well, the bank wants to know how they're doing. And a year goes by, you did pretty well, you call the bank back and I go, well, who are you? I haven't seen you in a year. I haven't heard from you in 18 months. I don't know if you're good, bad, or different. Now you start the courtship process all over again. Whereas when you're doing a quarterly review and you're giving financial statements and you're meeting with them, you're inviting them in, you're showing them the new customers, all of a sudden they're your partner. Because guess what? Banks want to lend you more money. They want as much money on your ledger as they can give you because that's how they get paid. That's all there is to it. That's all there is to financially managing your company. Not really, but that was the way I wanted to end, so. So I'm open to questions. This is not necessarily an easy form to ask questions, but I'm certainly open to helping any questions you might have.
Can you give a little bit of information on giving a financial statement to an investor or banker, whatever you can say, versus the reporting that you do to the IRS, how those two can differ?
That was not a plant, by the way. This is one of the beefs I have with traditional accounting and accountants. I didn't say this, but I teach one night a week in the MBA program at Xavier University. I teach finance. I do not teach accounting, although I'm a CPA. And I regularly just blister the accounting profession for what it does to people. So here's what happens. Most small companies have a tax accountant. That to them is their CPA. And your tax accountant views his job, he has one job. One job. He won't tell you this, but it's true. To minimize your tax bill. So what does he do? He loads up your income statement with all these costs. And his job is to get your income as close to zero as possible. Great, so you don't pay any taxes. You take that tax return to the bank, and they go, hell, you have no money to pay me. So now you go, well, yeah, but we did. So now the bank's going, oh, so you lied on your tax return. So now you want money from me, and you and your accountant lied on your tax return. Now, this is the dialogue going on in their head. They're not saying it, but I deal with banks all the time. I know what they're thinking. So what we do, now I'm Italian, so this comes off wrong. We keep two sets of books, okay? And there's two sets of books that every company is legally allowed to have. There's your tax books, and there's your GAAP books, generally accepted accounting principles, okay? The tax code has very different accounting rules than does GAAP. So there's actually in a corporate tax return, there's called a Schedule M1, and it says, here's your reported income on your book, and then here's what you reported for tax purposes, and here's the difference. Accelerated depreciation, things that are deductible for tax purposes that aren't deductible in book. And so it's important from a tax perspective, that's the last thing you want to show the bank. Now they want to see it to make sure you paid your taxes, but you need a financial statement that's prepared by a professional who knows what GAAP accounting is, because that is the true picture of your financial health. I'm not trying to wow you with that, generally accepted accounting principles. All of the big public companies, every public company in the free world is required to prepare GAAP statements. Tax statements are something that are kind of irrelevant to shareholders. When you're a shareholder, when you're a big investment house, and you're a big pension fund, you're investing in the generally accepted accounting principles version of statements. So you could have a company, and Johnny's company, for instance, showed, I don't know, $10,000 in income last year. He made $280,000 net. I know that because I went through the statements. And I talked to his tax accountant. He didn't do anything wrong, but it looks wrong and it feels wrong to bankers. And if you have a banker who's used to doing big deals and you come and need $500,000 and he gets a tax return that's shows a very low income, you know what you're going to get? Well, I'm sorry, I talked to the credit person and they're just not comfortable. He could have told you that when you sent him the statement, but he's waiting 2 days just to let you think that they gave it a good run. So is that the answer to your question?
But it's acceptable to do that.
It's completely, in fact, we recommend it. We do it for all of our clients. We take their tax report and we reverse engineer it back to GAAP. So you have to know how to do that. A lot of people don't know how to do it. A lot of your tax advisors don't know how to do it because they haven't done GAAP reporting in so long because the rules are so different.
Insurance carriers want to see profit, they want to see equity. And so sometimes what we want is not what we're being given because of the purpose of minimizing taxes. But you can have two different financial statements, and that's perfectly acceptable.
I have a bus company. He's got like 75 buses on the road, school bus. And he needed to buy another 100 buses, $8 million. Well, his accountant is doing everything on a tax basis. So I went back in and I adjusted. So instead of having almost negative retained earnings, he's got almost $1 million in retained earnings in his business. Well, hello, if you got $1 million in retained earnings, I will lend you money because that shows you're running a good business. But the way that the tax code allows you to deduct, he was keeping his books on a tax basis. Don't do that. I know some of you don't even know what I'm saying, and you may trust your CPA. I'm not trying to have you distrust your CPA, but their goal is not to get you funded. Their goal is to keep your tax bill low. That's a problem. You may have a very low tax bill, but you can't grow your business. So, you know, you have to be willing to do the right thing, get the right people in, look at it the proper way, put your profitability on it. The thing is, you can show $280,000 in net income on a book basis and $25,000 on a tax basis and be perfectly legal. But if all you present is what your CPA gave you, I mean, you're walking in flip-flops and shorts to the wedding. And so that's why the guy with the logistics company got turned down by 6 different people. And I walked in and got him, $3 million. And he was pretty mad too. He didn't believe he was going to write me that check. And I got check at closing. But it happens, and it's doable. The same way with the grain guy. It took me longer with him. It took a year. But it's doable. Other questions? One of the things I want to just talk about a little bit, because I know that the business owners in the room, my father was a small business owner. I helped him start his business. I was still in college, but I helped him with a lot of different things. And when he was 50 years old, he left corporate America and decided to start over. And he ended up with about $5 million in net worth. He did pretty well. So I have a lot of passion for small business owners. But what a lot of small business owners do, and this is admirable, but rethink it. They pay everybody else first, and they hope something's left at the end for them. Well, when you do a proper business plan, you put your slug in there. You put your take in there because the business doesn't exist except for you. So make sure you pay yourself first. I'm not saying be greedy and fire your people, but I'm saying that when you run a business and you are the reason that the customers have the service, you're the reason the vendors get what they get, you're the reason that the banks get what they get, and the equipment companies get what they get from you, you have to make sure that you're getting your fair share of the business. And too many business owners, because they haven't properly planned, they don't know how much they can take out, so they're fearful and they wait until there's a big accumulated number in their cash account. Sometimes that never comes. And if there's never enough to pay you, and you know that, it's January 15th, and I go, I don't think I can pay myself this year. Well, guess what? You got some more thinking to do. And you need to put a strategy together to fix that. You can't wait and hope. From everything I see today, I'm going to be able to pull $3,000 a month out of this. I can't live on $3,000 a month. Well, I'm just going to close my eyes and hope it's better. I'm not saying business owners are stupid or silly. I'm saying that there's a benevolence that comes with owning a business where you feel like you want to be so good to your people, but you have to make sure that you get yours. And that's a big part of what we do, is helping the business owners make sure that we can get them theirs. Any other questions? Because we're a little early. Well, I'll say this. Appreciate your attention. If anybody wants to talk about any of this, feel free to give me a call. Be happy to talk to you. Doesn't cost anything to talk. Be happy to see what I can do to give you advice. And if you need somebody in your local area to help you out, I could probably make a referral for you as well. So thank you.
Thank you.